I lost $627,997 US dollars. I lost out.
You just jumped into our series about bad investment. And today we are going to talk about something that's been draining investors for years. Actively managed mutual funds. They promise high returns and no risk. But really, is it like that? Let's find out. So what we're going to talk about is what you actually do pay for when you have these kinds of funds. And we're also going to give you examples on 2 different funds and how the difference can be.
Yeah, the must know for you.
The must know. And we have the Kat, the business lawyer, here to explain it.
Hi.
So you really know how to spot if it's a good or a bad investment.
So mutual funds that are pool of investments from you and I, we pool our money together, professional manager that then goes out and invests for us.
So I have a pro managing the money for me.
Yep. And the benefit, well, there are several. The pro is one in some form. And the other is that you get this buying power. Because if I want to invest every month, I might not be able to get exposure, this diversification that I can get if we all pool our money and then go out to shop, invest together, instead of just me trying to chase some small ticket sizes here and there, right?
Yes.
Yeah. So mutual funds as a core is a brilliant way to invest. I mean, the pooling of capital is a very good form for most people, most of the time. But we have an inherent problem. And I'm going to say that the US investors are better than the Europeans. They have come longer in understanding this. I think a lot is thanks to John Bogle and Vanguard, who's been preaching for years to watch out for high fees. Because we have 2 types of mutual funds. We have the passive and the active. The active, that's what you talked about, the professional management. Somebody sits there and evaluates, does the research, lifts the phone, presses the button, sell, buy, I want that, not that. The passive, that will copy an index. So it won't be an active decision. It won't be, I'm betting on Google today and I want to sell Tesla. It will copy Standard & Poor 500 or some other index. So it will always intend to mirror that, and the value growth will hence be the same as the overall market. And the overall market tends to go up. So that's good. And the problem with the actively managed is that the research and the data does not, in general, support that they ever outperform the passive ones. That means that they do not do better, but they do charge a higher fee. And it might not sound like much. I mean, imagine that you and I were offered to either go with a passive mutual fund that has a fee of 0.2%. Yeah, 0.2. That's annual, typical. So you get a 0.2.
Yes, thank you.
I want to go with this active. I'm so impressed. They're so enthusiastic. They know what they're doing. So I will go with an active fund that has a fee of 1.7.
It doesn't sound so much.
No, I mean 0.2 or 1.7. Yeah. And I mean, I'm good. I get these professionals watching my money.
That's good.
Yeah. But if we now then say that we have the same development, an annual growth of 7%, because that's reasonable to expect. And then if we invest year 1, we will have something called compounded interest on the money, because we have interest on interest each year. And I think Einstein actually said that this is the 8th miracle, because the one who understands it will get the world, and the one who doesn't will be paying for it.
Okay, that was really good.
Yeah. So let's try. Let's say we put in, how much have we invested?
100,000.
100,000.
Yes.
Yeah. Yearly growth 7%. Fee 1.7. Fee 0.2.
Yes.
So let's see. We can start with me. Let's see. After 10 years, I come knocking at the door, open my account, and I have a look. So active fund after 10 years, my money will have grown. Wow. 165,719. I will have paid fees in total of $23,073 US dollars.
And that was 10 years.
Yeah. How about you after 10 years?
Let's have a look. So after 10 years, I had a growth of 192,816 US dollars.
Oh, no.
So
Okay.
I had a bit more than you.
Yeah.
And fees total paid is 2,927 US dollars.
I don't like that.
You don't like that? Do you
No.
see the difference? It's
Yeah.
2,927 and you have 23,073.
And even more importantly, what do we have left in our account?
Yes.
Uh-oh. So, we're saving for the long run. We're going for the Miami house in Florida when we retire.
Yes.
So how about after 20 years? Let's start with me with my active fund with that fee of 1.7. After 20 years, I will have 274,629,000 US dollars. That's okay. And paid approx 61,000 US dollars in fees. Ooh.
In 20 years. So year 20 for me is, well, the growth is up to 371,780 US dollars. So it's a bit more than you.
Yeah.
And total fees paid is 8,571.
Okay, now we're talking.
We're talking a lot of money here.
Yeah. Perhaps I didn't make such a good call anyway.
Well, I'm really proud of mine.
Well, let's see after 40 years. It's time to buy that villa.
Yes. Now we're out for shopping and we're going to buy our house.
Yeah. So I'm about to cash out. And I can cash out 754,209 US dollars and paid fees approximately 230,000. But I mean, it's a good saving. I mean, still, I put in 100,000, and I mean, so saving does pay off.
Yeah.
Yeah. How about you?
My savings are up 1,382,206 US dollars.
Okay.
How about that?
Ouch.
Ouch. And total fees paid is 40,435 US dollars.
That means that because I choose 1.7, a little one. It's only 1%, right? I choose the higher fee of 1.7. I lost 627,997 US dollars.
Wow, that is
Paying for nothing.
crazy. What did you pay for?
Nothing. I lost out because you had it compounded, and I lost out because they dug a hole each year with the fees.
I mean, 627,000 US dollars, that's a life saving.
Yeah, that's crazy.
So I
It's a
think
game
I
changer.
managed good.
You did good. I did not do good. So this is what we want to show you, the importance of that silly little 1.7. Because if the active fund outperforms crazily, they can take a higher fee, right? But do know that those small percentages of fees will have an incredible impact. So do be mindful, do be careful. And there's little data showing that the active ones do outperform the passive index funds. So
how should
be
you...
mindful. That's all we want to say. This is not legal advice. This is not financial advice. This is information.
Yeah, you have it black on white. But
That
how
hurt.
should you think, I mean, to find a good passive fund? You need to do a lot of research, I guess.
Well, I would say no. I would say with the passive funds, it can also be ETFs. That's funds that are traded on the stock. The only difference is with the direct mutual fund, you buy and sell units from the fund. With the ETF, you buy and sell secondaries on the stock. But still, look at a passive fund that mimics an index that you know, that you're familiar with, and go with somebody that you trust. I mean, I don't want to give financial advice. I don't want to say anybody, but that's not too complex.
It is not.
No, they're rather stable.
Yes,
Yeah.
and it can actually end up you having $600,000 more if you just choose the right fund.
I would be okay with that.
Yeah,
I wouldn't mind.
I think we all agree on that.
Yeah.
Well, thank you so much for
Thank you.
clearing
Short and
this
sweet.
up. Yes, clearing this up in such a good way. If you like our content and think that this is valuable, like and subscribe to our channel. We're going to keep sharing this for your community, to know this good stuff.
Lovely.
Great.
Hej då!
Hej då!
Powered by.
And we're also powered by LE Fitness. Thank you so much for having us.
Hej då!